Okay, we will get started. I have about 11:03. So I want to welcome everybody to the call. I think it's budgeted for an hour. It will not take the full hour. I will leave some time for questions at the end. So if you want to jot them down and hold them till the end, we'll have a little Q&A at the end of the call. But I'm Jeff Roma, I'm owner of CAE Real Estate Investments. I know your time, like mine, is very valuable, so we'll try to make this count. This is 100% educational, so no pitch or no pressure. And I'm by no means a trained coach in this arena, but there's tons of great coaches out there that are. But what I do is I help people try to figure out how to invest in commercial real estate and generate and create generational wealth. So this is an important topic. I talk about it a lot with people. So I decided to put a webinar together because when speaking to people, I realized that not many know about these creative ways that we're going to go over today to access capital to be able to invest in commercial real estate. So, I speak to many people and they really want to invest, but life keeps getting in the way, right? You got to pay for that vacation, school tuition's coming due, you got to pay for summer camp, whatever the case may be. I get it. All those same issues come up in my life as well. But by the end of the call, hopefully you'll understand these three powerful vehicles for investing in real estate using money you likely already have sitting somewhere, right? So we're just going to need to uncover it. So we'll actually close with a real life example. I'll go over my Halifax, Pennsylvania self-storage facility just above Harrisburg, Pennsylvania. And that'll just show you exactly what it looks like to put put this in practice in full transparency with real numbers. And we do have an added bonus before we close the call. So you have the opportunity to actually register today for an investor call we'll have next Wednesday, where I will go over another deal. And if you are interested in that deal, you can certainly become an investor in that as well. So let's get started. A little bit, oop, technical difficulties. Let's see if we can get this. There we go. A little bit about myself. I am from upstate New York. I went to Temple University, actually lived in Pennsylvania now for longer than I lived in New York. Played baseball at Temple University, which was a great experience. We won a championship in the A10 back when they were in the A10. So that was incredible. So I currently reside in Chester County, Pennsylvania. I have three kids, twins that are soon to be 14, and actually my 11-year-old just turned 12. And so I have a passion for real estate. I got into real estate about 5 years ago. I do own some single family homes as well as self-storage commercial real estate. So it's kind of how I got into it. Purchased a couple of homes. I quickly realized that, man, if I were going to scale that, it would take quite a few homes, 75, 80, 100 homes to be able to generate any significant cash flow. So that's what kind of led me to commercial real estate and self-storage. Is the ability to scale, man. I'd rather have three self-storage facilities than, trying to keep track of 75 or 80 single family homes. And I do really love teaching people and helping people understand how they can invest in real estate and again, create wealth for their family. So, a quick note before we dive in, everything I share today is high level educational information. It's not tax advice, not legal advice. I'm not an attorney or personalized financial guidance. Now, I tap into my team for this kind of stuff, so my attorney and my CPA and things like that. But I am not that. So every situation is different. Everybody on this call has a different situation. So I strongly encourage you to take what you learn and bring it to your CPA, to your financial planner, or your attorney to understand how it might apply specifically to you, right? So basically, my job today is to open up the door. Your advisor's job is then to help you walk through it. So, quick little roadmap. We're going to be covering 6 sections today. Okay. So, the first half is pure education. We're going to be going over those three funding vehicles. And then the second half, we'll show you exactly how those vehicles connect to a real deal, something I've already built and is currently operating. Okay. So, let's start with the asset self-storage. So, why self-storage? It is a great asset. It is It's not a sexy or glamorous asset by any stretch, but it has historically been very consistent. As you can see by some of these numbers, 65 to 70% NOI margins, which is fantastic. That's about 2 times the profitability of a typical apartment building. And really the reason for that is there's very low overhead, right? So when a tenant in storage moves out, we're sweeping out the unit and getting it ready, putting a new lock on it, things like that. Very inexpensive. When a tenant moves out, you got to change carpets, paint, maybe update the kitchen, things like that. So there's very low overhead, which leads to great margins in storage. The COVID data here that you see is critical. So while hotels and retail and office and everything else was shutting down during that time, self-storage actually saw record demand. Now, what is the reason for that? The big reason is life events do not stop, right? People change jobs, people move, people get divorced, they're downsizing, they start a business, whatever the case may be. Those things don't stop. The other thing is month-to-month leasing gives us a lot of pricing flexibility that really other assets don't see. What I mean by that is we could adjust rates on the fly. So based on market demand, because we are month-to-month leases, so I can increase rates next month if the market supports it. And on the flip side, if we're in a downturn like COVID or something like that, we can actually ratchet our rates down to make sure we're preserving occupancy, right? So very flexible, which is great. Self-storage is also as many of you might know, a growing market, growing in popularity. Lots of people are talking about it over the last, say, 5 years. And honestly, as long as developers keep building homes, which I see a lot of these days, more storage is going to be needed, right? So let's dive into how to invest in storage or commercial real estate. So the first strategy we're going to look at is a self-directed IRA or an SDIRA. Before we get into what it is, ask yourself, do you have money sitting in an IRA or an old 401k from a previous employer? Most people do, and most don't realize that they can actually redirect that money that might just be sitting there. So self-directed IRA is not a different account type, right? It's the same IRA with the same tax rules, which is great. The difference is the custodian allows you to invest in alternate investments other than bonds, stocks, mutual funds, right? Like you would do through Fidelity or Vanguard. The rollover here is key as well. So if you do have an old 401k, you could roll it over and it's a zero tax event, right? So you're not penalized to roll it over. That money is often just sitting dormant in there. And now you can actually put it to work immediately. Now, there is one catch, and that is there is no self-dealing. So what does that mean? It basically means you can't use the money to self-benefit. You can't use it to buy a home that you live in. You can't use it to pay yourself to manage a property that you might own. You could basically take the money and passively invest it in real estate, other assets, but real estate. So that's the limitation. Now, the good news is if you are part of a syndication or you are part of an investment as a limited partner, so just a passive investor, that limitation goes away, which is nice. All right, so let's walk through each step. So how you would actually make this happen, right? It's pretty simple. You first need to choose a qualified custodian. Now that wouldn't be, again, Fidelity or Vanguard. There are companies out there, a few Equity Trust, Alto, Entrust. I'm happy to provide a list for people as well if they reached out, but it wouldn't be through Fidelity or Vanguard. So you're just going to easily transfer, roll over the funds into the self-directed IRA. Then you direct the custodian to invest in the specific deal that you're looking at, or if it's becoming a part of an LLC that's then investing in the deal, you can do that as well. And then all profits come back. So all your preferred returns, all your equity profit that you make flow back into the IRA, tax deferred. Okay. Or
I've
tax.
been listening while I'm driving to work because I think it's time. So I'm gonna be too late to work.
I'm sorry.
Oh, sorry. Oh,
Oh, I
God.
thought somebody had a question.
Oh, no,
Okay,
sorry.
no
Someone
problem.
come back.
Now the great thing is when a self-directed IRA is used, and let's say you're targeting a deal that's got 20 to 20% targeted annualized returns, again, that money comes back tax-free, right? That's the full picture. So a 20% annualized return sheltered completely from taxes is really, in investing, is a game changer. And also, if you open an SDRA and roll over funds, you can invest in multiple deals over time. So it's a permanent reusable tool, right? So this is a strategy where you're investing the money, you're not borrowing, right? So there's nothing to pay back in this strategy with a self-directed IRA. The next strategy is a solo 401k. So we'll go over kind of who the target would be and a good candidate for solo 401k. So if you have any self-employment income, so this could be a side business. It doesn't have to be a full-time business. You could be a W-2 employee with the company that you work for and have a side business and qualify for a solo 401k. So consulting work, 1099 income of any kind, again, even part-time would qualify you. Now, the really cool thing, and I have a solo 401k myself, and the great thing about it is the fact that you can contribute up to $69,000 compared to just seven in a traditional IRA. So that's a huge game changer. The checkbook control really just gives you the flexibility. It means faster execution on private deals. So back to the self-directed IRA where you need a custodian, you do not need that here. You can write your own checks, right? So you don't have to wait, especially if it's a deal you need to act fast on. There's no waiting for paperwork to process. Now, this does come again with a caveat like the last one. There is a loan provision, okay? So you are capped at $50,000. That's it. So even if you had $300,000 in there and it says you could take half, you can't because you're capped at 50. So if you have 50,000 in there, you can take 25. If you have 300 in there, you can only take up to 50. Okay. So that's the caveat. I mean, you would obviously take that money, invest it outside the plan, and then pay the plan back on whatever the terms are. It's essentially a self-funded financing strategy. Okay. All right, let's take a look at the two just side by side now that we've gone over a solo 401k and SDIRA. Obviously, the big difference here is you need to have some kind of, even if it's part-time as a business owner, income for a solo 401k, or anybody can qualify for an SDIRA. Contribution limits we just talked about, vastly different, right? Solo 401k allows much more per year to be put into the plan as compared to a regular or compared to an SDIRA. Both obviously can invest in real estate. The checkbook control, another big difference with between these SDIRA and solo 401k, and then the loan provision I think is huge as well. You're capped at 50,000 for the 401k. So if you have like a 401k sitting around, like I said, the fastest path for you would probably be a self-directed IRA. If you've got some self-employment income, I would suggest running those numbers, talk to a specialist that could offer a solo 401k to see if that might be a benefit to you. All right, and the last strategy, maybe the most exciting, is the HELOC. A lot of people have heard of HELOC. They maybe just don't understand how it works. Quite honestly, this could be a great tool. I mean, gone are the days where your home has become your retirement, or at least a chunk of your retirement, right? So with inflation the way it's been for the last, say, 15 or 20 years, I mean, the value of the dollar is getting crushed, right? So you need to find creative ways to grow your wealth. And in a lot of cases, many people have money just trapped there. So most homeowners have, six figures or a lot of money sitting in their home equity earning nothing, right? It's just sitting there. So that's the great thing about a HELOC. It activates it without having to sell your home, without having to touch your retirement, right? In this example on the slide, you'll see a capital cost of 8.5%. And if you're looking at a deal that's targeting, again, between 20 and 26%, you're keeping the difference, right? So it's an arbitrage. You're making money on equity you already have in your home. You already own it, right? So here's the best thing, actually. You can draw what you need. So think about it like a credit card that's secured by your home, right? So you could draw what you need, invest, get a return, repay it, and draw again. So it is a reusable investment tool. Now, I always suggest, as always, only use what you're comfortable to service up with your own cash flow, right? Any real estate investment is risky, right? So you never want to get yourself in a bad situation. So I suggest that. But again, your home secures the line. It's just similar to a credit card. So let's look at all three side by side as a little comparison. So I've gone over the self-directed IRA, the solo 401k, and the HELOC. So in your own head, maybe start thinking about which one describes where your capital might be living right now, right? Is it an old 401k? If so, you might be looking at doing an SDIRA or a solo 401k. If you got equity in your home, you might be looking at a HELOC. Now, the cool thing is you can actually combine them. So, as you're looking at this, you could pick what lane or lanes you might fall in because it might be more than one. Because everything I'm going to be talking about now in the next section is exactly what these three vehicles look like when it's applied to a real operating deal. Okay. So let me take you to Halifax, Pennsylvania. Okay. So Halifax is just above, if people know Pennsylvania, just above Harrisburg. And this is my deal, right? I built it with my own capital. So I didn't have any outside investors, but I'm showing you it because the numbers are real and they tell a story far better than, just throwing a slide together. So this is real proof that the model works. So just a little bit of background. It was a ground up development, right? So we built it from the ground up, 295 units that we've built in two phases. And overall, it's about 46,000 square feet. It is all single story, drive up, non-climate controlled. So kind of your traditional self-storage that you'll see. Like I said, we broke this into phases. So phase one is complete, and quite honestly, we'll go over here in a second, almost full. And we've got to that occupancy of 88% in less than a year. So we started lease up in June of 2025. Now in February, we'll bring on phase two, an additional 144 units. We are in fact ready to do that today, but in storage, sometimes timing is everything, and you like to try to time things if you can get into the rental season right at the start of next year. So we're going to bring those on about, in the springtime of 2027. So this is a real world version of everything we just talked about. So let's dive into the numbers a little bit. As you can see, we opened in June of 2025. First month open did about $700, and by the end of the year, we were up to about $10,000 in revenue. So we just came off of our best month in April, a little over $14,000, and you can see in the graph there, the blue bars are 2025, the green bars are 2026, and then to the right of it is our occupancy chart. Kind of tells the story of occupancy, which on a new facility, that is your number one goal, right? Let's get it filled up. And we are exceeding expectations on that, which has been great. So we've been absorbing units way faster than we've been losing them every single month, which is great. So again, this is a real operating asset generating real cash. Another slide here just showing the occupancy, which is great. You can see the graph goes up and to the right, which is what we always want to see. So like I said, we filled this up from 0 to 88% occupied in less than a year. In fact, we only have, it was 6 units a few days ago. It could be less available to rent. So that's a great position to be in, obviously, because now we can start to move our rates and try to get our rates up to what the market is. So this is none of this information is a projection. This is data that I've pulled really from our management system, which is called Storage. That's the software we use to manage the property. So this is a well executed ground up storage deal. So this is kind of what it looks like. All right, so let's break down this deal. So like I said, I'm the only investor. I didn't have any investors in this deal, but I wanted to show you what returns may look like, in a structured deal as a limited partner investor. All right, so what I did was created this kind of hypothetical under the same terms that we currently offer on the deal that we have in Wilkes-Barre. So we'll break it down. Let's say it hypothetically invest $100,000. You're going to get at 9.6% ownership. So that is your equity stake, right? So in this deal, we provide equity for your investment as well as a preferred return. So you're going to get 8% on your money. Just think about it like, a bank gives you money when you put money into their bank account. So we're going to give you money to hold it until we pay it back. So in this scenario, we're looking at a 3-year stabilization and then refinance, right? So if we did the math on that, that's $24,000 over the 3 years. Now the stabilized value of this property will be about, again, conservatively 4.2 million. And after paying off debt and limited partners, so we're looking at a spread of about $1.3 million in profit. So then that obviously you get paid out on your equity stake based on the profit that we made. So per that $100,000 investment, you're taking home about 50 in equity, plus your preferred return for a total of about $174,000 in distribution. So that's, if you do the math, roughly 20% of an annualized return, which again, there aren't many investments out there where you can turn over 20% and really with storage able to really mitigate your risk, which is nice. Now, inside of a Roth SDIRA, like we just talked about, with that strategy, every penny of that $174,000 would come back tax-free. So that's what investing as a limited partner looks like, right? So you're supplying the cash. You don't have to do any of the day-to-day. You take the returns you make, and it can go right back tax-free into your SDIRA. So a little side note, in this example, this is ground up construction. There may be deals out there that you come across and look to invest in where it's more of an acquisition, where those preferred returns can start to be paid back a little bit sooner than maybe, at the time of refinance. So just a little side note there, because every deal works a little bit differently. All right. Okay, so let's kind of tie it all together. So we talked about this self-directed IRA, solo 401k for business owners, and a HELOC. We connected them to that real deal in Halifax, Pennsylvania, to kind of show you the proof and real numbers. And now you're able to actually evaluate both a deal we just went over and the vehicle used to fund the deal. So that's great. And the vehicle doesn't change the deal, right? No matter what the deal is, the vehicle could be the same. It does, however, change the tax efficiency of the return. So in some of these scenarios, there's a huge benefit from a tax perspective. So that really is today's takeaway. All right. So before we get into some questions and question and answer, I wanted to leave you with one thought and an invitation, like I talked about. So Halifax, we just went over, it's a very rural market, right? We got to 88% occupied, and there's only about 6,500 people. So the population in a 3-mile radius is about 6,500 people. So not a huge market. And we're still able in under a year to hit 88% on phase one. Now, compared to Wilkes-Barre, which is a big market, it's the same model or similar, right? But the population is like 10 or 11 times. So we're looking at about 80,000 people in a 3-mile radius, 0 competitors in a 1-mile radius, which is, again, huge. And it's very, these are some of the things we look at when we're choosing a market to go into. The market there in Wilkes-Barre runs 2.7 square feet per capita against an interest standard of 8. So what that means when we look at saturation in a market, we look at how much square footage, per capita is in that market, right? So this tells us it's severely undersupplied at only 2.7%. So same operator, just me, same model, just a far bigger market. And we actually only have 4 units remaining to invest in that deal. It's almost closed, and I'll be presenting on it next Wednesday, May 27th. Okay, so I will leave this up. That is the link to register that I could pop it into the chat here in a second. So we'll be going over the deal. It's going to be a full walkthrough. Obviously, I just kind of introduced it here. It is a 90,000 square foot warehouse conversion. We will get about 600 units when it's all said and done. It'll be all indoor, climate controlled, and a much larger project of about 7.5 million. So in that call, we'll go over investment returns, projected returns, the full capital stack. Um, and I'm happy to discuss anything offline as far as how to participate with your 401k or HELOC or things of that nature. All right. Any, well, before we get into questions, I'm sorry, let's run through a little bit of a recap before we get into questions. So we went over self-storage, why it's a good asset. I think it's a great asset. It's very resilient, offers great returns, and there's obviously there's never no risk in investing in real estate, but we can mitigate risk very easily with some of these deals. And then we went over the creative ways to invest in, right? SDIRA, solo 401ks, and HELOCs, and then kind of tied it to that Halifax deal so you can get an idea of what that would look like. So now we can open it up to questions. If you are on mute, you could just take yourself off mute. If you have a question, you could throw it into the chat as well. I have the chat up, but I'll leave this open for a few minutes for any questions. Yeah, Mitch, go ahead and take yourself off mute. Oh,
Oh, unmute. How about now?
there you go. Yeah, we're
Okay,
good.
sorry about that. In my area, I'm in South Jersey, right outside Atlantic City, and the storage in this area is off the charts. And and I almost pulled the trigger on a lot very close to my house
Okay.
that has approvals for storage. But I got nervous. I thought, man, when is it going to be saturated? When is there going
Yeah,
to be too much? So
sure.
I backed off. And now somebody's putting storage on this lot that I was looking at. They haven't started yet, but I talked to the surveyors and it's going to be storage. But
Okay.
my question to you is, if I invested in storage, and I have capital, I'm like you, I started off 25 years ago buying small stuff, single
Yeah,
families. I got a couple of triplexes, a quad, a couple of duplexes, and stuff like that.
sure.
And I was thinking to cash out on some of my low performers because I own them all. I have no mortgages. I have no mortgage on my primary house. So I just got offered $700,000 for two of my properties, and I'm either going to be buying multifamilies, 10 units or up, or storage, but I just haven't decided yet. And I kind of felt like this area here where I'm at, it's only the big guys doing anything, and they're going up. They're all going to climate controlled and going up with
Mhm.
elevators and all that stuff. And I just don't have a lot of experience in self storage. Whereas with real estate, I've been a landlord for almost 30 years,
Sure.
and I know what I'm doing when it comes to smaller properties. Now,
Right.
learning the 10 units and above is a different animal. But so do you recommend looking for existing businesses like that? Like if I could pick up a facility, a 100-unit facility that's 100% operational, it's 90% full, it's got a cash flow. Is that a good investment, or is it going to be saturated
Yeah.
at some point?
No, good question. And you sound like me 5 years ago. I was kind of in the same boat, right? Like,
Yeah.
didn't know a ton about storage. Was actually back then even looking at a lot of deals, but similar to your, problem, I wasn't quite sure, right?
Yeah, right.
So the good news is I've learned a lot, and I've partnered with some people that know way more than me, and that's really the name of the game. So my partner in all of this is a guy that's got over 25 years experience, most of them with CubeSmart. So um,
Okay.
and to your point about New Jersey, it's pretty saturated. There's lots of storage. I know some storage owners in New Jersey, and there are still some good markets in New Jersey. Again, the good thing about Jersey is you get great rates, right? So compared to my Halifax example that I just went over, where our rates might shoot, we might get a rate of maybe $10 or $11, where in New Jersey you might be getting 30 or 40, and depending on the market. So
Right,
there are some
right.
good markets. Now, to answer your question, that is a good strategy looking for an acquisition, right? Now, depending on what your goal is, would determine kind of what deal you might be looking at, right? If you're just looking to say park money, maybe for tax purposes, and you're not too concerned about generating a whole lot of equity, things like that, you might be looking at, again, something that's, like you said, it's filled up, it's stabilized,
Yeah,
it's
yeah.
getting good rates, things of that nature. Where,
Let me help you so you understand
yeah,
where I'm at a little better. I recently retired. I ran a roofing company for 30 years. And right now I'm like really missing that income. I don't need it, but but I'm missing it.
sure, sure,
So what I want to do by turning some of my low performer, properties I have right now into better performers, because I want that income back.
yeah,
I want
I
the
hear
the
you.
money, the 100 and a half I was making uh back.
Sure.
So I'm thinking like, well, why not? My properties are paid for, got a ton of equity in them. And if I can convert some of these into better performers, I thought, why not? Now's the time. I'm retired,
Yeah.
so I got a lot of time to use my brain.
Yeah, no, I think you're on the right path. And honestly, if I could give one suggestion, I wish I maybe 5 years ago would have bit the bullet and joined a syndication. And I had an opportunity on a few self-storage ones, and I kind of kicked myself in the butt that I didn't.
Right.
Mainly because it would allowed me to get, gain some of that knowledge real life, going through it. So if you have that opportunity, I would suggest maybe taking it. It's a good way to, again, get your feet wet, get your foot in the door, start to learn about storage.
Yeah.
It's not an extremely complex asset, right? It's pretty straightforward and simple, but there are a lot of nuances, understanding markets. That would again be my biggest suggestion is, a lot of people go into it looking for a good deal, right? Oh my God, this is cheap. It sounds like a good deal, but you really need to dive into the market and understand what that market's doing, right? A lot of people get themselves into a situation where they buy that good deal, and then
Find
it's
out
not
it's not
it's
such a
not
good deal.
right. It's not generating income.
Yeah.
Populations leaving for whatever reason, things like that. So we do all that work up front. I don't even underwrite a deal, and actually, what we do to back up is we pre-select some areas, do due diligence in those areas to figure out the markets, and then we look for deals in those markets, right? So we
Right.
don't kind of do it in reverse. So that would be a suggestion of mine as well.
All right. Appreciate the feedback.
Yeah, and I'm open, Mitch, to, obviously my contact information is here.
I already have it. I got your email,
Perfect.
your phone. I
Open.
might be calling you.
Yeah, I'm an open book. I love chatting about this stuff. No
Yeah.
phone calls a
Yeah.
bad phone call, so feel free to reach out.
Yeah, I will.
Thank you. Cool. Anybody else? Thomas, how you doing, buddy?
Yay, I think I got myself off mute. There we go.
There you go.
Can you hear me all fine?
Yes, I
Yep.
can.
Yeah, good seeing you, Jeff. That's really good. Mitch, I can just second that. Getting involved and it's a team sport. I
Yeah.
mean, you really have to work with a bunch of different people. And I agree with Jeff, just hands down, wholeheartedly. You can be the best operator in the world, and if the market is not amicable or ready for storage, boy, it's just tough.
Hmm.
It's really tough. However, just jump in with both feet and learn as much as you can. Sometimes you want to join small groups of people. Take other people with you that have been there and done that before. The people there will show you the light of what the market's like and where. I was just on a Zoom yesterday with some storage folks, and I go, oh, that won't work. And then they underwrote it and broke it down and showed where things were working. And I thought, I didn't even look at that. I was completely blind to it. And I still not sure if I would have gone into that specific market. But boy, I was just, my mind was changed and the light was shown just on this strategy that you're able to use. So, and working with good operators, that's the other thing. Like Jeff had mentioned too. Good operators, I've seen them just do some fantastic stuff.
Well, I think I said that to somebody I was talking to, and I said, just because you buy a business that's making money and doing well, doesn't mean it's going to continue if you don't run it properly. So it all depends on the operator.
Yeah.
No matter what end, the operator that handled it well, that's selling it. If you don't do the same thing, it's not going to be successful. So,
Very good point.
I mean, that,
Exactly.
nothing's for nothing. You got to work hard to make it successful. I understand that.
Yeah.
And
And Thomas brought up a point, Mitch, and it popped into my head as you were talking. And if we're able to connect, I'll introduce you. But there are great groups out there, mastermind groups that you can join. It sounds like you might be the perfect fit, right? Somebody that's very interested in this. You got some capital to work with. Those groups are very good. You get a lot of people partnering with each other, sharing deals. I'm part of two groups, so it's good. It's great networking. Yeah.